Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking maximizing rental income. When does the rental room scheme really pay off today? And tying it back to the wider cost saver ecosystem, including tools like Rental Room Scheme Break-Even Calculator so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Hello, and welcome back to the Cost Saver Podcast. Today, we're getting into something that, honestly, I thought I understood this one, and then I started reading the detail and went, oh, okay, there's more to this than I thought. We're talking about the UK's rental room scheme. Assad, welcome back.
Thanks, Angela. Yeah, this is one of my favorite topics because everyone thinks they know how it works. You hear it at dinner parties, right? Oh, you can earn 7.5 grand tax-free. And that's true, but
But,
it's not always the best option, which catches people off guard.
yeah, because tax-free just sounds like, why would you not? So before we get into the actually maybe not part, can you just lay out what the scheme actually is? Because I think there's a lot of kind of half-understood versions floating around.
Sure. So, in a nutshell, the rental room scheme lets resident landlords, and that's a key term, resident, earn up to £7,500 a year, tax-free, from letting a furnished room in their main home. And for a basic rate taxpayer, that allowance is worth up to £1,500 a year of avoided tax. For a higher rate taxpayer, up to $3,000. That's real money for, 10 minutes of paperwork.
Up to 3 grand. That's not nothing.
No, it's not. And the thing is, that 7,500 figure has been frozen since the 2016-17 tax year. So it works out to $625 a month. It hasn't budged.
Oh, wow. So it's been that amount for, what, 8 years now? That's actually kind of.
Yeah, it's a while. And it's strictly your main home. The room has to be furnished, you can't use it for a self-contained flat with its own entrance, and you can't use it if you're like renting out your home while you're living abroad. It's really designed for the classic lodger setup, someone who lives with you.
Right, not a separate Airbnb unit in the garden or whatever.
Exactly. And both homeowners and tenants can use it actually. Tenants need their landlord's consent to sublet, but they do qualify. People forget that bit.
Oh, I wouldn't have guessed that. Okay, so what about couples? If, say, a married couple own the property, do they each get £7,500?
No. And this is one HMRC is very strict about. If two people own the property and both receive rent, the allowance is split, $3,750 each, not $7,500 each.
Wait, really? So it's per property, not per person?
Effectively, yes. Which is, yeah, it's a big difference if you're, budgeting based on the wrong number.
That's a huge difference. Okay, noted. What else trips people up?
So the other big one, and I cannot stress this enough, the £7,500 is a gross threshold, not a profit threshold. So if you're charging, say, $600 a month rent and then another $100 a month for bills and breakfast, your gross income is $8,400. You're already over the limit, even though your actual profit might be much less.
So it's not just the rent, it's everything you charge for. Meals, cleaning, bills, all of it counts.
All of it, yeah.
That's a bit of a trap for the unwary, isn't it? So what happens when you go over? Do you just pay tax on the bit above £7,500 or?
Right. So this is where this is where the actual decision-making happens. Because HMRC gives you two methods. Method A is the renter room scheme itself. If your gross rent is below £7,500, you pay nothing. You don't even need to declare it. If it's above, you pay tax on the amount over $7,500, but, and this is key, you can't deduct any expenses.
No expenses at all?
None. Zero.
It's the trade-off for the simplicity.
So if I'm earning £8,000 and the allowance is 7,500, I pay tax on that 500, but I can't say, well, I spent £400 on their electricity.
Precisely, which is why there's method B, the traditional profit method. You declare all the rent as income, but then you can deduct allowable expenses, your fair share of bills, repairs, wear and tear on furniture, insurance, council tax, all of that. And you pay income tax on whatever's left, the net profit.
Okay, so it's a genuine choice between two systems.
It is. And does this make sense so far? The whole game is figuring out which one leaves more money in your pocket in any given year.
It does, yeah. And I'm guessing you don't have to pick one forever.
No, that's the beautiful thing. You can switch year to year. Just tick a different box on your self-assessment return. So if your boiler dies one year and you spend $3,000 on repairs, that might be the year to opt out of the scheme and go method B.
Oh, that's actually really clever. I like that. So, okay, give me the rule of thumb. How do you know which method wins?
Right, so the simple version is the rent-a-room scheme beats the traditional method whenever your allowable expenses are less than your gross rent minus 7,500 pounds. Let me make that real with some numbers.
Go on.
Say you let a spare room for $500 a month. That's $6,000 a year. You've got about $400 a year in extra costs, share of bills, insurance, whatever. Under method A, $6,000 is below $7,500, so you pay zero tax. Done. Under method B, you'd have $6,000 minus $400, so $5,600 of taxable profit. A basic rate taxpayer is paying over $1,000 on that.
So, method A wins by a mile in that scenario.
Country mile, yeah. Now, what about higher rents? Say you're in Zone 2 London charging $950 a month. That's $11,400 a year. Expenses are, I don't know, $1,200?
I would have guessed method B starts winning at that point, honestly.
And that's what most people think. But no. Method A, $11,400 minus the $7,500 allowance, you're taxed on $3,900. Basic rate, that's $780. Method B, $11,400 minus $1,200 expenses, that's $10,200 profit. Tax on that is over $2,000.
Wow. So method A saves you what, over $1,260 even at that level?
Yeah, the $7,500 allowance is it's really powerful. Even in the scenario where you've replaced a boiler and done essential repairs, say $4,500 in expenses on that same $11,400 rent, method A still only costs you $780 in tax. Method B would be $1,300.
That's actually surprising. So even a new boiler year, you might still stick with method A.
Right. You'd need truly enormous expenses to beat it. Like the source material mentions, you'd need more than $2,500 in provable expenses on $10,000 of rent just to break even. And that's break even, not win.
So when does method B actually come out ahead? Is there a realistic scenario?
Honestly, it's pretty narrow. Method B only wins when your allowable expenses are larger than the gap between your gross rent and $7,500. And here's the thing. If your gross rent is under $7,500, method A always wins. Always. Because you owe nothing. Even if you had $4,000 in shared repairs on $5,400 of rent, method A is zero tax. Method B still leaves you paying something.
Right, because zero beats any positive number.
Exactly. Hard to argue with zero.
Okay, but you mentioned earlier that the tax calculation is only half the story. What are the other things that sort of change the picture?
Yeah, so there are a few hidden factors. The big one, and this catches a lot of single people off guard, is council tax. If you live alone, you get a 25% single-person discount. Take in a lodger, and that discount disappears overnight, unless your lodger is a full-time student or otherwise exempt.
Oh, how much are we talking?
For a Band D property in England, roughly $450 to $600 a year, just gone. And that's not really a clean allowable expense under Method B either. It just eats into your real take-home regardless of which method you choose.
That's actually a lot. You might need to bump the rent by, what, 50 quid a month just to cover it?
Yeah, that's basically what people end up doing. Quietly increase by $50 a month.
And the source mentions that council tax bans could be reviewed in some UK regions, so you shouldn't budget for today's rates as if they're permanent either, which is kinda a lot to think about.
And then there's insurance, right? I've heard normal home insurance doesn't cover lodgers.
Usually not. You'll likely need a policy that explicitly mentions lodger cover. That can add $50 to $150 to your annual premium. And most mortgage lenders require written consent before you take in a lodger, usually granted. Sometimes there's a small admin fee, but look, if you skip these steps, you risk invalidating your insurance and potentially breaching your mortgage terms. Neither is worth the saving.
No, definitely not worth that risk.
Phone your insurer and your mortgage lender before you advertise the room. Get it in writing. It takes 10 minutes and protects everything you own.
Good advice. What about energy bills? Because most lodger setups are bills inclusive, right?
Yeah, most are, which is simple, but it means a chunk of the rent is just covering heating, electricity, water. If your home is poorly insulated, that chunk gets bigger every winter. A few £100 of loft insulation can genuinely keep more of the rent in your pocket. It's one of those things, you know?
And I suppose there's the whole living with someone aspect. It's not just numbers on a spreadsheet.
Yeah. A lodger lives in your home, eats in your kitchen, has a key. The financial math matters, but so does picking the right person. Reference checks, a written lodger agreement, a deposit, 1 month's rent is normal. And the deposit protection schemes don't actually apply to lodgers since they're excluded occupiers, so it's held informally.
Wait, excluded occupiers? What does that mean in practice?
It means you can ask them to leave with reasonable notice, usually matching the rent period. You don't need a court order like you would with a tenant. That flexibility is actually one of the underrated perks, but it cuts both ways. They can leave just as easily.
Fair enough. So pulling this all together, who really benefits most from the scheme?
So the scheme is a strong fit for homeowners with low expenses. Modern home, steady boiler, nothing falling apart. Single occupiers who are already paying all the bills. Anyone wanting simplicity, because if rent stays below £7,500, you might not even need a self-assessment return. The classic live-in landlord renting one room. And, as I mentioned, tenants subletting with permission.
And who should probably look elsewhere, or at least think twice?
Anyone whose gross rent regularly exceeds about $10,000 a year with significant repair costs. Joint owners, because that allowance gets halved. People doing short, frequent Airbnb-style stays where cleaning and laundry costs eat into margins. Anyone letting unfurnished rooms, they just don't qualify. And, this is crucial, the moment you stop living in the property, the scheme stops applying, even mid-tax year. That's a regular buy-to-let at that point, completely different rules.
Oh, I hadn't thought about the mid-year thing. So if you move out in September...
The scheme stops from that point, yeah.
Okay, quick question. What about benefits? If someone's on universal credit, does this mess things up?
So income from the scheme is generally ignored for universal credit calculations up to the $7,500 threshold. But, and I'd really stress this, check with your work coach or the gov.uk benefits calculator before you commit, particularly if you're on any means-tested benefit. It's worth the 5 minutes.
And you don't have to register with HMRC?
Only if your gross rental income exceeds $7,500. Below that, you don't need to declare it or file a self-assessment return for the lodger income alone. Above that, you file a return and pick your method.
That's actually reassuring. So, if someone's listening to this and thinking, right, I'm gonna do it, what's the order of operations? What do you do first?
Okay, and the source says this typically takes 2 to 3 weeks. First, check your mortgage terms and get lender permission in writing. Second, update your home insurance. Third, if you're a leaseholder, check the lease because some prohibit lodgers entirely. Then decide your rent and factor in that lost council tax discount if it applies. Draft a written lodger agreement, rent, notice period, house rules, bill arrangements. Run reference checks, previous landlord, employer, ID. Take a deposit, and then, Even if you plan to use the scheme, keep basic records of rent received and any major expenses.
Why keep records if you're using Method A?
Because you might need to switch methods one year. If something expensive happens, a big repair, whatever, you want those numbers ready. You don't want to be scrambling in January trying to reconstruct a year's worth of expenses from memory.
Yeah, that sounds like a nightmare. Okay, Assad, let's wrap this up. Can you give us the key takeaways?
Sure. So, the rental room scheme is genuinely one of the most generous bits of tax relief available to ordinary UK homeowners. $7,500 a year, tax-free, no receipts needed, no fuss. For most people, letting a single furnished room, it's the right answer almost by default. Basic rate taxpayer saves around $1,500 a year, higher rate up to $3,000. But almost by default is not always. Joint owners, high-rent landlords, anyone facing the year of big repairs, sit down, work both methods through. It's 20 minutes of homework that could save you hundreds.
And don't forget the hidden stuff. Council tax discount, insurance, mortgage permission.
Yeah, phone your insurer, phone your lender. Do it before you list the room, not after.
Brilliant. Thanks so much, Assad. Really useful stuff. And for everyone listening, there's a calculator linked in the show notes if you want to plug in your own numbers and see which method works for you. We'll see you next time.
Thanks, Angela.
Quick side note. This guide connects with other cost-saver blogs, especially Complete Guide to Home Insulation ROI, Free Ways to Cut Energy Bills in Winter, and Postcode Crime Data and Rental Risk.
Exactly. And reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like Rent-A-Room Scheme Break-Even Calculator right after this episode.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try Rent-A-Room Scheme Break-Even Calculator, then read Complete Guide to Home Insulation ROI, and use them together to take action today.